Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you, as always, here for clicking and giving us a few minutes of your time so we can cover things that we found important from this week's investment meeting. I will tell you, there's no way to say that this is kind of an even investment business where each and every week you have equal amounts of data. Some of you just kind of have not a whole lot going on. Others you have more important. I would categorize this as more important. So we'll try to dive and unpack these. They're not particularly complicated concepts, but they are important ones. So we're going to talk about the market and its history from making new highs. We saw that in the S&P 500 here recently. We're talking about interest rates and expectations here going forward. Had a big change in that last week. And then we're going to talk about the technical update and specifically with the difference between new highs and new lows and which direction those are going. So let's dig right into the data. And we'll start actually talking about inflation and its impact on interest rates and the outlook. Last week, we got data that indicated that inflation rates were hotter than was expected for the January data release. Which sent the markets, specifically here talking about the bond markets, in a wild reversal. It's been a particularly volatile 3 or 4 years in fixed income, and these last several months have been no difference there. We go from a place last fall where we were working our way towards higher and higher rates as the Fed was pushing Fed funds rate up and up and up to where we got kind of a maximum pessimism. Everybody's selling whatever bond that they possibly could. And then all of a sudden we get information and a release that the Fed will be pivoting and moving towards a rate cut regime. And that just sent markets into a frenzy the other way, buying all those bonds that they had sold and pushing interest rates lower and lower and lower and doing like they always do, going too far to a place where in that Fed pivot, in the Fed's outlook, they saw 3 rate cuts in 2024, but the market's exuberance pushed that all the way to 6 or 7. I think we've hit that at least a time or two in these market carvers this year. And the inflation report we saw last week really just took those extra cuts out of the picture. They're back to looking about where the Fed's outlook is for 3 rate cuts this year. So a few things I'll just say about that stronger than expected inflation report and where we stand on that and how to react portfolio-wise. And the first is that it was absolutely firmer. And if you take a look at the last 3 months, there's a foundation there where there could be a little bit of kindling to reignite that inflation flames. I don't say that in a super like hyperinflation way, but it could begin to trend the other way. And that's what's got fixed income investors worried. But I do give you a few things else to keep in mind. The first is that even though the last few months have been higher, the overall trend has been for inflation to come down. This chart's looking at the core CPI. There's a lot of different ways to look at inflation. Core is the preferred way because it's less volatile and strips out oil and things that really move around a lot. You can see the underlying trends. That is still on a year-over-year basis going the right direction. Nobody would have ever expected this to go on a straight line down to the Fed's target of 2% and be there. There's no doubt the past few months have gone the other way, but the overall trend is going down. The second that I would give you is that this is the core CPI, which biggest weighting inside of this is shelter costs. Far and away, that is the biggest piece and the biggest piece of most people's budget. And it takes some time to actually measure the impact of shelter costs. We saw rent growth begin to slow all the way throughout 2023, and especially as we ended the year coming into 2024. And so there's some confidence that what we saw in a bounce doesn't really have major legs. So we'll be seeing that going forward. And lastly, in addition to that, we had a record amount of apartments hit new supply in 2023. So it'll be interesting to see what impact we see there. It should offer further relief to rents, and if not, maybe push them down, at least keep rent growth muted. So that's the overall picture there. And in terms of the rate cut or rate increase, really the overall picture here is that the Fed still wants to be tight, and nobody will dispute that. They want to be restrictive because they've got to get that inflation down to 2%. But as inflation falls, they got to move interest rates down just to stay at the same level of tightness. So that's inflation. Now we're going to move to stocks and take a look at what happens when they hit new highs. And this is going to be so counterintuitive. It took a long time for me to understand this, because I was always taught you buy low and sell high, and that's a great I think shorthand or way to think about financial markets, but it trips us up in the way we actually implement portfolios. So we're going to throw up a chart here to show you what actually happens when the market hits a new high for the first time in at least a year. And as we can see here, the tendency is for it to continue to go up. Whether it's 1 month, 3 months, or especially on out into 6 and 12, it is unambiguously a positive sign that the market's getting onto new highs. And that can especially trip a lot of investors up because let's say they get out on the way down, the pain is too great to take. And so they see the market make a big comeback and make new highs. And then they think to themselves, well, I can't get in now. We're already at a new high. So that is one of the things that we have to work hard to overcome and help encourage that hitting new highs isn't necessarily a bad thing. In fact, it's often a good thing. And I do give Andrew a lot of credit for helping instill this and bring this technical perspective, which is really the lens with which this manifests.
Thank you, Adam. The other comment I would make is this is when we look at new highs, it's momentum. We want to see momentum continue. And this is actually an excellent segue into the topic that I'm going to bring it up. The next chart that we'll be sharing is looking at just that, new highs. So the chart Adam was showing, that bar chart was looking at when the S&P is making a new high and then the ultimate return. Something that we often want to look at is also how are individual stocks doing? Are they making new highs as well? And a common topic each week in the allocation meeting, and something we have been talking every once in a while here in the Market Carver, is that a lot of the new highs peaked at the end of 2023. We can see on this chart, if we look all the way to the right, there was that really tall bar right at the end of 2023 in December where a lot of stocks were making new highs. And then once we dropped the ball and start the New Year's Eve ball and we started 2024, we're starting to have less than that number back in December. And there's still a healthy number of new highs. We're just having fewer as the index itself is going higher. And so if we look on the far right of this chart, we can see that declining blue line. That's showing us that we're having slightly fewer new 6-month highs. But what's also important as we look at the bottom panel is we're not seeing any new 6-month lows. We're basically at, as of last Friday, it was 0.6% of stocks were at a 6-month low. So basically a rounding error. So that's a very good sign. So even though we're not seeing stocks continue to go higher, this is telling us they're kind of starting to consolidate. They're not dramatically going down. And a great example we can look back to is the last time we saw the market have any sizable correction. It was the 10% drop last summer that began in August and drifted down through October and then to early November. And so we can see, looking at that time period, once again, we saw the new high list start to decline. If you look at the blue diagonal line towards the left-hand side of the chart on the new high list, we started seeing less and less stocks making 6-month highs while the market was going higher. But again, we weren't seeing an increase in new lows. So stocks weren't starting to dramatically drop yet. And then when the market in August dropped about 2%, we then bang, you see the blue circle on the 6-month low list. We saw this really big move of increase in new 6-month lows. It was actually a 3-month high of new lows in the market, telling us that, okay, now we're starting to see confirmation from the individual stock level that stocks are starting to decline, and that's a bad sign for the overall market. Again, when we talk about the S&P 500 or any index, it's truly a market of individual stocks. So if we start seeing the lion's share of those stocks go down, it's going to be very difficult for the overall index to continue higher. And that's exactly what we saw for about 2 quarters of the market slowly drifting down, and we corrected by about 10%, which, as we've talked about in prior market covers, is very normal. We have to typically do see some degree of drawdown each year, but we started seeing signs of that when we started seeing less stocks making new highs, similar to we are today. And then we got confirmation for that when we started seeing more stocks making new lows. We're not there yet, but it's something we're very, very conscious of, and we're starting to monitor each day, watching, are we starting to see an increase in new lows? And that would help give us confidence that maybe we are starting to see the market roll over, among many, many other pieces of data, as I'm sure you can imagine. But we thought this was a good representation, showing kind of a comparison of last year and this year. And while we're starting to see the bullishness type data is starting to dwindle, we're not seeing that bearish data start to increase, which we're encouraged by. So we'll be watching this very closely going forward, and then making, of course, any adjustments that we feel appropriate based off as the data changes.
Thank you, sir. Thank you, Andrew, as always. And thank you to all of you for giving us this time. As always, we'll give you a reminder here If we can be of service, please give us a call, 800-928-4001, or scan the QR code and book it electronically. Hey, thanks again and have a great weekend.